have had a great year on technology and crypto, and having offset some of that in bonds. So I still think bond yields end lower, but there is a risk that they lose control here because of the supply side, and there's not enough liquidity in the bond market right now. I think that increases the chance of some yield curve control, whether it's like an intervention in the bond market. And we've seen that in the past. It's not uncommon for the US to do. Japan obviously does it. The UK did it recently as well. So I think this turns around, but could it squeeze higher first yields? For sure.
Welcome back to Library of Wealth. Today, as we step into a world of financial intrigue and dynamic market forces, we'll hear the latest prediction from Real Vision CEO, Raoul Pal. With the keen eye of a seasoned investor, Pal casts a spotlight on Bitcoin and the expansive cryptocurrency market, recognizing their significance against a backdrop of economic uncertainty. With an air of urgency, he also highlights the mounting concerns encircling the colossal $6 trillion debt maturation slated by year-end. Amid this fiscal tightrope walk, Pal discusses the economic indicators we're seeing, as well as the debt dynamics, and the pivotal role of central banks in shaping the market in the last part of the year. He points out that the Federal Reserve, steadfast in their quest to maintain interest rates amidst a storm of mounting inflation and debt pressures, aim to orchestrate a balance between taming inflation's fiery wings and upholding the pillars of the economy. This steadfast commitment to a higher-for-longer approach stands as a cornerstone of the current economic narrative. As we journey through the latest interview with Raoul Pal, we'll look at the ripple effects across the investment landscape and how Bitcoin and cryptocurrency are now reshaping the very fabric of finance. Don't forget to share your thoughts and comments down below, and leave a like if you enjoy the content we do here.
And I've spent a long time actually thinking about this. I say that flippantly, but actually I spent a long time thinking about this because all of the business cycle indicators, all of the inflation, forward-looking inflation indicators, all of the unemployment indicators are all suggesting that bond yields should come down and that inflation continues to fall, both at core level and at headline level, and that unemployment continues to slowly grind higher. So why are bonds not suggesting that? While equity markets already started pricing in the fact that there's more liquidity in the system, I think it's really down to supply, because the Treasury has to issue a lot of bonds to finance both the interest payments from the bonds that are coming from maturity, set at higher rates, and the new borrowings that they have. The bond market is already trying to absorb a bunch of this stuff, and there's just not the ability to absorb it all. So supply is pushing yields higher for the time being as the Treasury rebuilds its coffers. The issue is there's about $6 trillion of debt maturing between now and the end of the year. What the Treasury have been doing is issuing short-dated notes generally to finance it. The reason they're doing that is they don't want to lock in 5% rates, because before you know it, the budget deficit explodes high. So there's a game that I think they're playing here, is the Federal Reserve have to, and all the central banks are doing the same game, because I think they're all in cohorts, part of this everything code theory. They are going to try and hold this rates up as long as possible to make sure inflation undershoots. Because when it undershoots, they have the cover to cut rates back down to trend rate of GDP growth, which is like 1.75%. This issue of the Fed staying as long as possible because they really want to have the complete green light to do what they want, crush inflation expectations. The market knows rates are too high, obviously. So they're saying, listen, you can't do this for long. And the Fed keeps shunting them along. And this is the higher for longer argument, which has been pretty accurate. The question is how fast does it reverse? And the market never usually forecasts this right. Normally, once they do cut, they cut faster than the SOFR curve or the Eurodollar curve used to in the past. So we have to wait and see. But it's all to play for in Q4 for me. If rates become unanchored from inflation, economic growth, or anything else, it says there's a structural problem in the market. We know there's massive structural problems in the lending markets because there's too much debt. And if you lose control, the Federal Reserve can't allow loss of control. And don't forget, they're just being downgraded because of the mess that the US is in because of its political impasses and everything else. If they lose control of the bond market, that's the world's anchoring asset. Should not be allowed to happen. So in which case, they will come in and stop it. And we saw that in March of 2020. They did the same, where rates got ridiculous on the other side, going down, just completely, all liquidity dried up and the market broke. We have a risk that we could break the market again here, and in which case they will step in and say, we'll have to increase quantitative easing and buy bonds but you could do it at a fixed price and say, we'll buy all bonds at 4.25% or whatever the number is, that they say, look, enough's enough. We know that the regional banks have problems with their bond positions. And if bond yields keep rising, they keep losing money. That makes them illiquid. And with high rates, there's money moving from deposit accounts in banks that are only paying 0.5% and moving to money market funds that are paying 5%. So they're losing their deposits and they've got losses here. Every time you take a deposit out, you have to kind of unwind some of the trades, but they're all down. So there's a huge, massive mark-to-market loss that goes on. And they're having to borrow money from the Fed to fund that right now. Also, if the bond market breaks, it means that there is not enough participation from the key participants, banks, asset managers, market makers, to keep market liquidity. So prices start gapping around, setting interest rates which were not the intention of the Federal Reserve. And if they're setting interest rates that were not the intention of the Federal Reserve in a very meaningful way, then it can create problems. So it is very risky here what happens to the bond market. So people need to keep an eye on it. The equity market might not like it either. Even the crypto markets may not like it if yields go up, because that puts pressure on everybody on their borrowing costs. Now, most mortgages in the United States are longer duration, but we've seen credit card financing rise. We've seen car leases rise. We've seen all forms of short-term financing rising. Corporations rolling over debt if they've got short-term debt, that's going up. And the US government themselves need to fund their bloody debt. And they're rolling over all of this debt. And the last thing they want to do is try and roll out 10-year debt at 4.5% when the last time they were paying the interest on it, it was 1.5%. Suddenly you triple your interest payments, and then you have to borrow more money to have the interest payments because the taxation rate's low. We've got some dangerous dynamics here, which is why they need to cut rates. You could see that the end game of the debt make it impossible to deal with. Now, most people think there's a debt default. I don't think there is a debt default. I just think that the use of central bank balance sheet goes exponential, which increases the cost of assets, but nobody's wages go up. It's like a mutualization of these interest payments across the general population without raising taxes. It's the same thing.
And by the way, the decline in purchasing power in the currency.
And that's a mutualization of losses amongst everybody. But rich people hold assets, so they're protected. The less well off have incomes. Their incomes don't go up as much as the assets, so they're poorer. So that's where we're getting this income disparity.
Raoul Pal uncovers how changes in cryptocurrencies can send ripples effects through our wallets. Imagine a world where borrowing money becomes more expensive. Those cool credit card deals and car leases might not be as sweet. But it's not just about numbers. It's about fairness and how many things we can buy. Among the market noise, Bitcoin emerges as a rebel in the money world, shaking up old traditions. Pal points out that the everything code is like saying money is this invisible thread that's connecting it all together. With big banks being the guardians of balance, he says they're working behind the scenes to keep things steady, preventing financial chaos, but he believes the inevitable is coming. What do you think about the latest interview with Raoul Pal? And how do you think his prediction for Bitcoin, crypto, and the financial market plays out in the last part of 2023? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.